A notice appeared on the CFTC website. Most people missed it. It was posted after market close, buried in the regulatory announcements section. But the headline should have stopped the world. Emergency Commission meeting scheduled for Thursday, December 19, 2025, 9 a.m. closed session. The topic listed market stabilization measures for the precious metals complex. In government speak, that is a very specific code. It means we are about to change the rules to save the banks. I have been covering the silver market for years. I have seen manipulation. I have seen suppression. I have seen every trick in the book, but I have only seen this specific move once before. You have exactly 72 hours until the game changes forever. That meeting on Monday morning, it isn't a discussion, it's a sentencing. They have already decided. By Monday afternoon you might not be able to buy silver on the COMEX. By Tuesday, that ban could extend to ETFs. By Wednesday it could reach the physical dealers. This is not a drill. This is the empire striking back. Let me show you the exact notice because the language matters. The announcement reads, the Commodity Futures Trading Commission will convene an emergency meeting to address urgent matters related to market integrity. I am not a financial advisor. This is not financial advice. I am not affiliated with anyone mentioned here. This is purely a forensic analysis based on public information. But we have seen this movie before, and if you don't know the ending, you are the one who pays for the production. To understand why this specific notice is a death knell for the current price structure, we have to look back to 1980. This is not theoretical. We've seen this movie before. Nelson Bunker Hunt and William Herbert Hunt were Texas oil billionaires who realized early that inflation would destroy the dollar. They did the only logical thing. They bought silver. By late 1979, they controlled roughly 1/3 of the world's deliverable supply. They weren't just buying paper. They were demanding physical delivery. As they bought, the price moved from $6 to $50. The Hunts were winning, but the banks were dying. Institutions like JP Morgan and Engelhard were net short. They had sold silver they didn't have, and they were facing insolvency. So, they called their friends in Washington. On January 7, 1980, the COMEX board held an emergency meeting. Exactly like the one scheduled for this coming Thursday. They didn't raise taxes or ask for permission. They simply implemented Silver Rule 7. It instituted liquidation-only trading. This is the most dangerous phrase in the history of markets. It meant you could sell your silver, but you were legally prohibited from buying more. If you held a long position, you couldn't roll it forward. You were trapped. The effect was a mathematical certainty. If everyone is forced to sell and no one is allowed to buy, the price can only go in one direction. Silver crashed from $50 to $10 in just 6 weeks. The Hunts were wiped out. The banks were saved. The government called it restoring order. The reality was a targeted execution of private wealth to protect institutional debt. 45 years later, the same architecture is being rolled out. They aren't changing the strategy because the strategy works. The reason this matters right now is because the math has reached a breaking point. History isn't just repeating, it is accelerating. To understand the 72-hour countdown, you have to see the modern parallels. In 1980, the Hunt brothers held 200 million ounces. Today, the open interest in silver futures represents approximately 700 million ounces, nearly an entire year of global mine production. In 1980, the banks were net short and desperate. Today, commercial banks are net short over 250 million ounces, and they are facing a massive options expiration this Friday. The physical reality is even more disconnected. In 1980, there was a developing shortage. Today, COMEX registered inventory has plummeted to 92 million ounces. Refineries are reporting massive backlogs, and physical premiums are already hitting $12 over the spot price. The price action is the final signal. In 1980, silver spiked to $50. Right now, as I record this, silver is sitting at $62 and climbing vertically. The mechanics are identical. The banks are trapped. They sold silver on paper that does not exist in the vaults. When the holders of those paper contracts demand the metal, the system breaks. In 1980, the CFTC used an emergency meeting to force liquidation. This coming Thursday at 9 a.m., they're using the exact same playbook. The dates have changed. The technology has changed. But the desperation of a cornered banking system remains the same. They are not meeting to discuss the market. They are meeting to stop it. Most people believe the market is a neutral field governed by the laws of supply and demand. They are wrong. The market is a legal construct, and that construct has a kill switch. How can the CFTC simply ban buying? To find the answer, you have to look at the Commodity Exchange Act, specifically Section 8A9. This is the legal hammer they will swing on Thursday morning. The law states that the Commission may take emergency action if it determines that an emergency exists which threatens the orderly execution of trading. Here is the catch. The law does not define what an emergency is. It is entirely discretionary. If the price goes too high and the banks face insolvency, the CFTC can simply declare that the market is disorderly. Once they declare an emergency, they gain near absolute power. They can impose temporary trading restrictions without congressional approval, without public comment, and without due process. These restrictions can last for 120 days and can be renewed indefinitely. This is exactly what happened to the Hunt brothers. They sued the government, claiming the rules were changed specifically to destroy them. They lost. The courts ruled that the CFTC has the broad authority to do whatever is necessary to protect market integrity in plain English. Market integrity is a euphemism for bank solvency. When the government wants to rig the game to save the institutions, they have the legal framework already built and tested. You can sue them, but you will lose. The precedent is set. The hammer is already raised. They are just waiting for 9 a.m. Thursday to let it fall. To survive what is coming, you must visualize the timeline. This isn't just a meeting, it is a synchronized strike on the price of silver. Based on the 1980 playbook and the current CFTC schedule, here is exactly how Thursday, December 19th will unfold. 9 a.m. the blackout. The CFTC meeting begins in a closed session. No media, no public, no transcripts behind these doors. They aren't debating, they are signing the orders for liquidation-only mode and massive margin hikes. Last DSE 30 Alta M. The press release. The meeting concludes. A press release hits the wire. It will use words like protecting retail investors and ensuring market stability. Effectively, it will announce that large traders can no longer increase their positions. They can only sell. Las 11 Alto M. The media blitz. CNBC and Bloomberg break the news. The talking heads will frame this as regulators stepping in to cool a dangerous bubble. They will not mention the bank's insolvency. They will focus on responsible oversight. Las 11 30 M. The gap down. Silver futures will gap down instantly. Why? Because the biggest buyers, the hedge funds and family offices, are legally blocked from buying the dip. If you can only sell, the price has no floor. We could see silver drop $10 to $15 in a single hour. 2 p.m. Retail panic. Retail investors see the red candles. They don't know about Rule 8A9. They just see their portfolios bleeding. They panic sell their ETFs and their call options. By the time the market closes, the banks have successfully wiped out the gamma squeeze and covered their shorts at a massive discount. Here is the secret the CFTC docenti want you to realize. They can control the price of paper, but they cannot control the reality of the metal. What we are about to witness is the great decoupling. The COMEX is a digital casino. When the CFTC switches it to liquidation only, the paper price will crash. But silver is not just a line on a screen. It is an industrial necessity. Solar panel manufacturers in Shanghai, electronics firms in Germany, and silver refineries in Switzerland do not care about CFTC press releases. They need the physical metal to function. As the paper price on the COMEX drops to $50, the physical price in London and Shanghai will do the opposite. Why? Because industrial users realize the COMEX is no longer a reliable source of supply. They will rush to other markets to secure whatever physical bars remain. This creates a massive divergence. You might see paper silver trading at $50 on your phone, while your local coin shop is charging $85 if they even have stock. This is called backwardation, and it is the market's way of screaming that the paper price is a lie. The COMEX is about to become a zombie market. Miners will stop delivering their silver to an exchange that artificially suppresses the price. Why sell to New York for $50 when you can sell to Shanghai for $80? Once the physical metal leaves the COMEX vaults, the exchange becomes irrelevant. The CFTC thinks they are saving the system, but they are actually destroying the very mechanism that gives the dollar power over commodities. They are winning the battle for the paper, but they have already lost the war for the metal. The window of opportunity is closing. If my analysis of the 1980 playbook is correct, you have until the markets open on Monday to position yourself before the premiums explode and the restrictions take hold. Here is your tactical checklist for the next 72 hours. Action 1. Resolve paper positions. If you hold silver futures on the COMEX, you are in the direct line of fire. You have 3 choices. Exit now and take your profits. Roll your position to the LBMA in London or the Shanghai Gold Exchange where the CFTC has no jurisdiction, or demand physical delivery immediately. Be warned. Once the emergency is declared, the exchange may suspend the delivery process entirely. forcing you into a cash settlement at a suppressed price. Action 2. The ETF warning. If you own SLV or other major silver ETFs, understand that these funds rely on the authorized participants, the same banks that are currently net short. In 1980, and more recently during the 2021 silver squeeze, we saw these funds change their prospectuses overnight. If the COMEX goes into liquidation only, these ETFs may halt redemptions or stop trading altogether. If you aren't comfortable with your capital being frozen for 120 days, you need to exit now. Action 3. Physical acquisition. This weekend, Saturday, Sunday and Monday morning is your last window for normal premiums. Go to your local coin shop, go to reputable online dealers, buy whatever you can, coins, bars, rounds. By Thursday afternoon, one of two things will happen. Either inventory will be zero, or dealers will raise premiums to $30 or $40 over spot to protect their remaining stock. Action 4. Do not sell physical if you already own physical. The upcoming crash in the paper price is a head fake. It is designed to make you panic and hand over your metal to the very banks that need it to cover their shorts. The government intervention is the ultimate proof that your thesis was right. You don't sell your insurance policy the moment the fire starts. The rule changes are only the first half of the attack. The second half is the psychological warfare they are about to unleash on your screen. Starting Thursday afternoon, you will witness a coordinated messaging blitz across every major financial network. The narrative is already written. CNBC, Bloomberg, and the Wall Street Journal will run identical headlines. Regulators step in to protect retail investors from silver speculation bubble. They will frame the CFTC's intervention as a heroic act of responsible oversight rather than a desperate bailout for the banks. They will interview experts who will compare the current silver rally to past failures like Tulip Mania or the GameStop short squeeze. They will call you a reckless gambler. They will tell you that the fundamental value of silver is much lower than the market price. Why? Because they need you to believe you were wrong. This is gaslighting on a global scale. If the media can convince you that the price crash is natural, you will sell. You will hand over your physical metal at suppressed prices, providing the banks with the very supply they need to escape their trap. When you see this blitz, remember, they don't run coordinated national campaigns to stop bubbles. Bubbles pop on their own. They run coordinated campaigns to stop the truth. The fact that they are pulling out every weapon in the arsenal, regulatory, legal, and media, is the ultimate confirmation that they are terrified. They aren't trying to save you from a bubble. They are trying to save themselves from you. What we are witnessing is the final phase of institutional desperation. Throughout history, whenever the government intervenes to save a market, they aren't saving the market, they are saving the politically connected institutions that broke it. In 1933, Roosevelt confiscated gold because the banks were insolvent. In 1971, Nixon closed the gold window because the U.S. could no longer meet its delivery obligations. In 1980, the CFTC crushed silver to save the short-selling banks. In 2008, the SEC banned short-selling of financial stocks to stop the bleeding. In 2020, brokers turned off the buy button to save the hedge funds. Every single one of these interventions was an admission of defeat disguised as protection. They don't intervene in things that are working. They only intervene in things that have already failed. The CFTC emergency meeting on December 19th is the white flag. It is the proof that the paper silver market is dead. The banks have sold more silver than geology can provide, and they have run out of time. They are changing the rules because they lost the game. This is not the end of silver. This is the beginning of the end for the paper manipulation scheme. The physical market is taking over, and in the physical world, there are no emergency meetings. There are no liquidation-only rules. There is only metal or no metal. You have 72 hours. Use them to move from the world of paper promises to the world of physical reality. Hold your silver, ignore the noise, and watch as the greatest transfer of wealth in modern history unfolds in real time. The system is breaking. Make sure you aren't standing underneath it when it falls. Subscribe.